Good afternoon and welcome everybody to Wall Street Reporter's next Superstock live stream for today, July 22nd, 2020. And we have an exciting new company to introduce to you today. It is Weyland Tech. Stock symbol is WEYL, over the counter. The CEO is Brent Sun. And for those of you who are new to the program, our goal at Wall Street Reporter next Superstock live stream is to bring you stocks which have 10x to 100x upside potential. So these are companies which have several things in common. One, they're going after massive market opportunities, multi-billion-dollar opportunities. Two, they are at key inflection points, so they are right at the threshold of explosive growth, and they have multiple catalysts in place to ignite that growth. So those three factors, and those of you following our live streams over the past year now have watched as companies we've brought onto this next Superstock live stream have all delivered those those qualities, and we've seen stocks increase between 10x and 20x so far. So we've had Nextech up 1,400%, Imagine AR up 1,300, and we've had Cytodyne up 2,000%. So today we're going to find out if Weyland Tech is our next 10-bagger or more. So with that being said, we're going to start the presentation. Please watch the Brent's presentation. Ask your questions. I mean, the highlight of our live streams is really the audience Q&A. So please ask your questions to Brent at the end. This one about 20 minutes from now, and then decide for yourself if Weyland again is that next Superstock. With that said, I want to turn it over to Brent. Brent, you're on.
Great, thank you. Good afternoon, everyone, and thank you for joining. I would like to begin by pointing out that the presentation that we're giving is also on our website. That is weyland-tech.com. So in the investor section, and that's in addition to a considerable amount of information, both from the reporting side and also on the product and service side. You'll also be able to pull up any news, Securities and Exchange Commission filings, and pretty much anything else you would need. So the PowerPoint that I'm going through again is on our website. I will not be reading line by line. Instead, I will overview the high-level points. And with that, the next slide is the disclaimer and cautions regarding forward-looking statements. I won't read it, but it is there. I'd like to start with the key statistics. I would point out that our current stock price, this is yesterday's close of $5.90. Our market cap right now is currently about 68 million. And if you look at our trailing 12-month revenue, you'll see 41.1 million. Therefore, our multiple of revenue is about 1.66 times. I point that out because the benchmarked valuations in our space are for both public and private companies that operate in the various business segments that we're in. Those valuations, which I will overview shortly, range from a low of 7x revenues to some considerably higher, as high as 30x revenues. And again, we'll discuss that shortly. As you can see, we have grown from roughly 12.9 million back in 2016. That was our first full year of owning our core product, Create App. We've grown quite nicely over the years. Last year, we finished up with 34.6 million. And then if you look at the trailing 12 months, you'll see a contribution of 3.2 million for Q1 from Logic, which we acquired on January 8th of this year. On the next slide, essentially we have three major business units. Our core business, Create App, is a subscription service-based platform that caters to small to medium-sized businesses to create their own mobile app. We acquired them in 2015, and they actually started in 2013. So again, the first full year of having them under our belt was 2016. Earlier this year, we acquired Logic. Logic is in the ad tech and big data segment. They're based here in the US, Minneapolis, in fact. Our third line of business is a Southeast Asia, Indonesian fintech business that has an e-wallet and a food delivery app. So essentially we have points of presence in Asia. We have a headquarters in Singapore. The Logic headquarters is in Minneapolis, and we have a 200-person development team in India. And then in Myanmar, we've got another 5 senior professionals there that lead the engineering efforts. The next few slides are actually describing the overall market. I think it probably comes as no surprise to all of you that e-commerce and m-commerce, or mobile commerce, if you will, are here to stay. The overall market opportunity is tremendous. I don't need to go into that, but you can find that in open source research. It's certainly here on our slides, and this is coming from Forrester Research and eMarketer. Nonetheless, the opportunities are tremendous, and they've grown very nicely and will continue to do so. I would point out that on this next slide, this shows mobile commerce as it compares to overall e-commerce and how it stacks up in terms of overall global penetration. Right now, you're looking at roughly 67% penetration on a global basis. If you look to Southeast Asia, where we have a regional focus, you will see that mobile actually comprises 78% of e-commerce. Here in the US, it's a bit less. It's actually 45%. So Southeast Asia is roughly 73% higher than the US in terms of commerce that's transacted through the phone. The next slide is the industry landscape. Further statistics on Southeast Asia, as it is not a region that most in the US are familiar with. However, we compare the stage that Southeast Asia and specifically Indonesia is in today as similar to the China opportunity 7 or 8 years ago. I would also like to point out that Indonesia and then Southeast Asia on whole are currently the #1 area of focus for emerging markets institutional investors. Going back to our business units, I'd like to describe Create App, which is our core business. It is a platform as a service, or as most of you might be familiar with, it's also described as software as a service. I think the simplest and most easy way to describe that business is Shopify for mobile. Essentially, any business owner can have their own dedicated app within 2 hours. There are roughly 75 modules or functionality, and this platform is currently offered in 14 languages in the regions with the world's most active mobile users, in fact. We're categorized as e-commerce software as a service if you were to look for publicly available comparables. Again, launched in 2013 and acquired by Weyland in late 2015. Going on to Logic, we acquired them in January of this year, again, based in Minneapolis, Minnesota. The simple description of the business is it falls into the ad tech or advertising technology space and big data. I would say that currently the split is about 75% ad tech, 25% big data. We are currently in an evolutionary phase where we are moving more towards big data. This is not a Me Too movement, if you will. If you look at e-commerce on whole, you look at mobile commerce, you look at our core business, Create App, you look at Logic, you look at what we're doing in Southeast Asia. Big data is underlying all of this. How that's used in terms of customers has grown over the years and will continue to do so. So big data is a theme that we'll continue to evolve into, and you'll be hearing a lot more about it as we move ahead and start to make strategic announcements. In terms of the fit between our core platform, Create App, and Logic, the recent acquisition, what you'll see on this slide are essentially what we call the 4 pillars of e-commerce or mobile commerce. And those are marketing and analytics. They are mobile or e-commerce fintech, managed services, which also encompasses big data, data analytics, and ad tech, and in effect driving end customers of our customers to effecting transactions or sales of products and services. Logistics or last mile delivery is the final component. We do not actually provide logistics. We have our platform that pulls in logistics carriers depending upon which region one is in. As far as the revenue model goes, it is a combination of subscription-based. Our core product and platform, Create App, is a software as a service based on a subscription model. We charge $12 to $80 per month, depending upon the level of functionality. So we collect on a monthly basis, so pay as you go. Logic is a combination of subscription-based ad revenue and also managed service contracts with large customers, which I will highlight on the next slide. If you take a look at this slide, and certainly it's on our website, and we also outline some of the relationships with partners and customers that we've aggregated over the years, you'll see some very familiar names in terms of partners globally, and then customers both here in the US and then abroad. I think that's important because not only does it provide validation and credibility, it can also give insight into the overall landscape of whom we provide products and services to, and what that could mean in the future in terms of also bringing on similar type of clients. I would also point out that several of these are publicly traded on the New York Stock Exchange, the Euronext market, and NASDAQ. On the next slide, this highlights our fintech business in Southeast Asia, Indonesia. It is, again, the big emerging market for institutions. Back in mid-2018, we invested in and launched an e-wallet business, which is known as ATOS Pay. It's an e-wallet that is similar, yet localized. So I would compare it to, say, a Square, Venmo, Apple Pay here in the US. Why would we want an e-wallet? Well, if you look at emerging markets, specifically in Southeast Asia, what you do find are that about 90% plus of the underlying population have mobile phones, smartphones, However, depending upon the country within Southeast Asia, you'll see what are called unbanked consumers, meaning people without bank accounts, and that ranges from 40 to as high as 90%. So therein lies the challenge for people that want to purchase things through their phone and the ability to pay for them. So if they don't have a bank account, and even fewer have credit cards, they would need an e-wallet. So we launched an e-wallet as a preface for rolling out our core product, thereby enabling consumers to pay for products of our customers, as well as products and services offered by other companies in the region. ATOS Go, that is what we call a hyper-local foot-powered food delivery service that we just launched last fall in Indonesia. We currently have a little over 110,000 subscribers, which we accumulated over about 5 months. With COVID, there was a slowdown, primarily because Indonesia was locked down, but it's opening up again. Our goal is to have around 1 million subscribers by the end of the year. What you will see, if you look around the global landscape, is companies like Uber Eats, Postmates, Grubhub, Delivery Hero in Europe, and then Grab Food and GoFood in Southeast Asia. You will see values placed on consumers ranging from a low end of about $120 per user to some as high as $340 per user. This is evident both in the public markets as well as merger and acquisition activity when you look at the valuation paid and then the underlying consumers. So both businesses have experienced very nice growth over the year and few years. Our strategy, which we have mentioned publicly and continue to do so, is that we intend to sell a stake in both businesses sometime this year. And then there is an eventual exit strategy on our roadmap to sell the business in its entirety sometime over the next 18 to 24 months. And there is a tremendous amount of acquisition activity in this space. So we're quite enthusiastic about it. Going on to financial highlights, 2019, 34.6 million. That was almost 100% generated by our core business. And what you'll see in Q1 of this year is that Logic contributed 3.2 million to our top line of 41.1 million. So you'll continue to see growth from them and contribution. Going on to exciting and what we like to talk about in terms of disparity in the public markets are valuations. These next 3 slides will be talking about valuations that are relevant to us in our underlying businesses. And these valuations are a combination of what we call private company and public company valuations, as well as M&A comparables. This slide right here shows names that might be unfamiliar to most individual investors. However, from the institutional landscape, you'll see some of the best names on the planet in there. If you take a look at SEA, out of these names and out of the 15 unicorn valued companies in Southeast Asia, this is the largest. They did their IPO on the New York Stock Exchange 2 years ago. It was led by, I believe, Morgan Stanley. Their investors include Goldman Sachs and Morgan Stanley and a whole host of others, which if you look them up, you'll see that they're all tier 1 strategic and financial investors. Their IPO valuation was about 3.4 billion. Their current market value is 55 billion, and they're trading at a price to revenue metric of 23.4x revenues. If you look at the other companies listed here, you'll see other investors ranging from Alibaba to SoftBank to JP Morgan, Sequoia, Expedia. It is literally a who's who of the best investors on the planet, and they are all active in Southeast Asia with a specific focus on Indonesia. What you'll see at the bottom here is an average of 13.6x revenues for funding valuations. Weyland Tech currently is trading at about 1.7x revenues. So there's quite a big disparity in terms of where we're trading and what funding valuations and the singular publicly traded comp are trading at. This next slide has mergers and acquisitions in our space. If you look back, you'll see some of the valuations back in 2018 up until January of this year. Some small, down as small as 65 million, some as large as 5.5 billion, and then Flipkart, which Walmart acquired in May of 2018 at 16 billion. The takeaway here is that if you look at M&A valuations, you'll see an average of 6.6x revenues. Again, we are trading at 1.7x revenues. On this slide, you'll see public peer valuations, and of course, you'll see Shopify, SEA Limited, Veritone, and Wix. They are certainly larger than we are, and that is primarily because the space that we operate in does not have a number of publicly traded micro cap companies around. But I do find it relevant that on a price to revenue basis, the average is 29.6x revenues. And again, we're trading at roughly 1.6x revenues. So from these three slides, you can see that there is a low end of roughly 7x revenues to a high of close to 30x revenues. We're trading at 1.7x. So we do believe that there's a big disparity. We do believe that upon further execution and broadening the audience through endeavors such as what Wall Street Reporter is providing us with, we can get the message out, and we hope to see this valuation gap narrowed. Going on to growth drivers, what you'll see this year is a continued focus on expanding channel partners, more offerings on the platform. Very importantly, you'll see gross margin improvement. That's going to be a combination of value-added services and then expanding the revenue base. We've also entered several new markets on the Create app side, which we announced recently, and we'll see those start to gain traction in Q3 and 4. We acquired Logic in January. It would not be out of the question to pursue some what we call tuck-in acquisitions of additional data-based, big data-based services to enhance the product and service offering. And on an outbound basis, again, we've publicly stated that we intend to sell a stake in our Indonesia fintech operations, and we believe that we could sell the entire business sometime in the next 18 to 24 months, or even possibly take it public through an IPO. Key takeaways, although we have the ones listed here, what I would personally point to is that huge valuation disparity between where we're trading and what our peers are trading at. It would not be prudent to just hear a presentation, see the slides, make an investment decision. I think that, as with any investment, doing one's own due diligence is key. Research other publicly traded companies, the ones that are listed here, the ones that you find on Bloomberg, on Yahoo Finance, Google Finance. There are a number of avenues to take to engage in due diligence, to look at what public comparables are, look at what privately held funding valuations are. Look at M&A, and then look at the market opportunities. What you will find is that the market opportunities speak for themselves. The valuation disparity, the way that that's narrowed is through continued introduction to both institutional and individual investors who continue to hear the story, believe in what we're doing, following our strategic announcements and following the roadmap that we've followed, and then looking at the opportunity that's representative of our valuation versus peer valuations. So with that, I would like to also again point out our presentation is online. There are appendices on this presentation that I would strongly encourage you to look at. The management team of Weyland Tech and Create App, the management team of Logic, our board advisors and board directors. What you will see is that there is a breadth and depth of tenure, work experience that ranges from very well-known publicly traded global companies on the tech side to financial experience at major investment banks, PE funds, and M&A firms, as well as telecom, mobile, and software as a service, both startups and enterprise size companies. So rounding that out and being able to say that we can scale very readily from where we are now to a much higher market cap, and then certainly an underlying business that supports that is doable very readily by our team, our directors and advisors. So with that, I'd like to thank everyone for listening to the presentation and open it up for Q&A.
Okay, Brent, can you hear me? Brent, can you hear me?
Yes, I sure can.
Okay, perfect. Okay, great. So we're going to jump in with the live questions first. So let's go to Richard. He's asking, how much market share does Weyland have with e-wallet service in the Asia markets?
That's a good question, Richard. The market itself is considerable. I would point out that it's changed from an overall market perspective each year because the forecasts have been adjusted upwards because of the underlying traction. To put it in context, I believe this year we're going to see roughly 11 billion in transaction volume just in Indonesia alone. Of that, we represent a very small percentage of that. Our e-wallet will generate roughly 25 million in transaction volume this year. Although that represents a very small percentage, I would put things in context as it relates to both the e-wallet and the food delivery business, and then on a greater scale, the whole thesis behind Create App, and then the management vision at Logic. With each of these businesses, and then overarching, we set out to build to eventually sell a stake in or sell entirely these businesses at normalized market valuations. In order to do that, there has to be a significant amount of differentiation in positioning. So the mindset there is, how do you position to where you are attractive to an acquirer? That is not necessarily based on how much market share you have. It's what differentiation you have that a potential acquirer, the big guys, if you will, that they will view as scalable to them. So they're not viewing us as, wow, what would 25 million in transaction volume add to our, call it 500 million or $1 billion in transaction volume. It's more, where are they located? what type of underlying merchants and consumers are using it, and if we were to commit larger resources, how would that scale up? And that looks more like this as opposed to the way we've grown it like this. I hope that answered your question. Again, it's all based on positioning.
Okay, we've got another question from Richard. What strategic advantage would Weyland generate with planning to sell portions of their business lines in Asia? What capital projects would fund this, or would this pay down debt?
As a matter of fact, we actually have very, very low debt. At the end of last quarter, we had a loan facility of $2 million. I cannot speak to this quarter because we have not reported it yet, but we have historically carried little to no debt over the years, so debt pay down is not a consideration. The investment that we've made into the Southeast Asian operations year to date is a total of right at $3.7 million. If you look at the benchmarked valuation of our Indonesia operations, if you compare it to what's going on in the M&A spectrum and then apply it to us, that would yield a valuation that's attributable to Weyland shareholders of currently of around 33 million. So it's roughly half our market cap. If we were to sell now, which we do not plan on selling entirely now, we would look to probably pay out a special dividend to shareholders of part of the proceeds, and then commit the rest to expanding either new products and services that are similar to what we're currently doing, or expanding on the logic side. And we'll certainly evaluate it as things move forward. What I would also point out is that discussions that we are having and that we have publicly stated are ongoing as it relates to selling a stake in the Southeast Asia business. These were made during a point in time where COVID was, I won't say at its peak, but the markets were at their trough, and so we believe that those are very low ball valuations. I think getting back to a normalized environment later in the year and stepping up these discussions, you'll see valuations that are clearly benchmarked and would potentially yield a much greater payoff to, if I can use that word, to the company and to our investors.
Okay, Grant is asking a question. Grant, can you clarify the question? I'm not quite sure. Let's go to Richard. He's asking, why do you feel the valuation is held down to a multiple of 1.7x by the market? What event or recognition would be needed to propel your valuation higher?
Sure. Okay. I believe it's a combination of things. For one, there's no internal naivety in comparing ourselves to larger publicly traded comps. Those are used more as points of reference because you will not find many publicly traded comparables that are micro cap and sit within our market segment. We view these also as potential acquirers. Given the fact that we are on a junior market and not on a senior exchange, partially leads to low institutional investor interest. Up till a few weeks ago, we were at less than 1% institutional ownership. If you look at most companies that are on a senior exchange in our space, you'll see institutional ownership ranging from lows of 40% to highs of 60-70%. That is notable because a step up in institutional recognition and interest also propels market cap. Getting in front of a broader audience as we are now in through Wall Street Reporter as well as other conferences that will attend will be key to getting that message out there. I think just to sum it up, it's just general unfamiliarity with us. As with thousands of other companies, it's easy to get lost. But I believe that with a compelling story, a big disparity in valuation, we should hopefully narrow that gap.
Okay, let's jump to some questions that came in before the event, and then anybody with more questions, please ask your questions. We'll get back to you right now. So Marty asked, despite increase in revenue, why do the outstanding shares continue to increase?
Okay, that's a good question, Marty. So last year, we embarked on several funding raise initiatives. If you look at not only our business, but other peer companies that operate in mobile apps for small businesses, you look at software as a service, you look at big data, ad tech, and then if you look at the comparables on the Indonesian fintech, the reason that these companies trade at multiples of revenue and not multiples of earnings is because there are no earnings. Essentially, the entire landscape, regardless of which company you look at or which industry segment that we operate in, you will not see any profitability, and you will not see any for at least two to 3 years. So therefore, everything is trading at a multiple of revenues. The reason why is it's about market share, it's about staying current on R&D, specifically the development, and trying to maintain that momentum. So capital and raising funds around that trajectory is instrumental. So without raising additional funds, it is extremely difficult to compete and extremely difficult to position. So we did 2 funding rounds last year, and then this year you will also have seen a $25 million stock acquisition of Logic. The contribution that it's making to revenues this year, we believe provided a very attractive valuation at which we acquired them. So that led to the increase in shares outstanding. However, if you look at us now, roughly 12.2 million shares issued and outstanding, a market cap of 66 million and a valuation metric of 1.7 times revenues, I would not say that dilution has put us in a position to where we are either fairly valued or certainly overvalued. It's actually given way to continuing to be undervalued, especially with the acquisition of Push and the way that we've deployed the capital that we've raised.
Okay, we've got a question that came in from E. He's asking, are you subscription based? How many current paying customers do you have?
On the Create app side, we are 100% subscription based. We have a total of 390,000 end customers around the world. I would point out that these customers are aggregated primarily by resellers and distributors whom we have strategic partnerships with over the past 5 years. And then if you look at the Logic business, that again, that's a combination of subscription based for their own websites that generate traffic, ad tech revenues, and then managed service contracts with large enterprises such as Quinn Street, Home Advisor, and Sunrun, which incidentally are all publicly traded on senior exchanges.
Okay, Russ was asking, what segment of products do you see the greatest return over the next 12 months?
Can you clarify that question, please, Russ?
Well, he asked that last night, so it's from. But I guess the question is, which part of your business do you expect to see the most upside in?
Okay, sure. Okay. If you look at our core business, Create app, the growth that we've experienced over the past 5 years has been roughly at about a 45–50% CAGR. I believe that could continue. We've stated that publicly. If that does slow, that would be due to a shift in customer focus where we're going after higher gross margins. What you typically see with most SaaS businesses is generally higher margins, which we are evolving towards. So that would address the Create App business. If you look at the Logic business, roughly 75% comes from ad tech and managed services, and then 25% is big data. We are shifting that to where we believe that over the next 18 months, on a combination of M&A plus organic growth, that will flip. So we'll see roughly 75% being generated from data analytics, and roughly 25% being ad driven. So between those two, Create App and Logic, I would say that Logic probably is going to show the biggest gain in terms of upside, because the margins, the gross margins on whole, if you look at big data companies, and there are, I think, 12 to 15 publicly traded ones, ranging from the Trade Desk to Splunk to some recent IPOs such as Lemonade, Zoom Info, Palantir, which Elon Musk was one of the founders of. I'm sorry, Elon Musk and Peter Thiel from PayPal. They're launching their IPO, I believe, next month. You'll see big data companies trading at valuation metrics which are an average of about 30 to 40x revenues, so quite high. And that is a function of their gross margins ranging from 80 to 90%, because big data analytics do generate those margins if you have business models similar to theirs. So apologies for that sort of a long answer to a short question, but Create App should continue to grow as we have. If there's a slowdown in top line, it will be because there are expanded gross margins because of customer mix. On the Logic side, again, shifting from ad tech to more big data analytics generated margins should propel growth.
Okay, Brent, so we get about 5 more questions that's from last night, and then we'll see if we can jump into any live questions if anybody has more live. But let's go to Sean was asking, is the business cash flow positive? And if not, what is the runway? And when is cash flow positivity expected?
We're actually looking at Q1 of 2021 overall. However, if you look at how Logic, we've just rebranded it, in fact. If you look at how Logic did in Q1 of this year, if you look at the announcements we've made around it, and then you look to our what we'll be reporting in Q2, it should give a very good insight into the potential for that side of the business being cash flow positive by Q4 of this year. Again, what I would point out is that if you look at the landscape, whether it's software as a service companies for e-commerce, and again, look at Shopify, look at Wix, look at the companies down the chain. BigCommerce just filed for their IPO, so you can see their S1 online. And then you look at companies in Logic space. You look at the privately held companies in Indonesia and Southeast Asia and their fundings. Again, earnings and cash flow positive, although important from an overarching investment thesis, are not the goals in the near term, because if you drive towards that goal in too short a period of time, it is absolutely at the expense of gaining market share, staying current in terms of underlying technology, and positioning yourself to becoming attractive to a strategic investor or acquirer. So although we're certainly driving towards it, trying to drive towards it too soon will end up bringing harm to us overall. So hope that answered the question.
Okay. Brent, that was a good explanation of why. That's actually a great explanation of why, yeah, companies choose growth over immediate profitability. So let's go to let's see here. Okay, we got a question from Leonie, I believe. What will be the impact on Weyland with the projected exit, or I guess sale of Atos Pay Go?
Atos Pay and Atos Go. Okay. To provide context, transactions that are happening in Southeast Asia. Again, if you go back to the slide, which shows unicorn valued companies, and again, look online, there are roughly 15, maybe as many as 20 companies valued at over $1 billion. Again, all supported by tier one strategic investors, Silicon Valley, VCs, Wall Street, PE funds, and investment banks. You'll see M&A activity and private funding valuations occurring at an average of 12x revenues. Or if you look at gross transaction volume, which you look at Atos Pay, we're generating 25 million in gross transaction volume for this year. If you take the benchmark of 3 to 4x GTV, and again, these are benchmarked valuations. Let's just take 3x GTV. That's an implied value of 75 million. Weyland Tech owns 31% of that outright, so that would be roughly 25 million in value if we sold it right now. Okay, again, COVID valuations, a non-normalized environment, but underlying, you see the positioning we have, the area we operate in. The customer mix is very different from the peer landscape in that we've gone after smaller merchants. We've gone after lower income merchants, whereas typically the peer landscape, they go after mid to high tier income and merchants. So what you find is they come down that chain. It happens in all markets. They're already starting to, and what that does is it sets us up to have a strategic stake taken in us or being acquired outright. So therefore, an evaluation metric today of 3 to 4x GTV, that implies a valuation of 75 to 100 million overall. Applying a 31% ownership to that would be an implied value to Weyland shareholders of 25 to 31 million in additional value. However, if you look at Atos Go, the food delivery business, the differentiation there, it's foot-based versus scooter or motorcycle or car-based. Our delivery people are able to deliver in 15 minutes instead of the average of 45. Although we have only 110,000 customers, we are driving towards 1 million by year's end. But based on current metrics, that part of the business alone, if you look at mergers and acquisitions by Uber, Grubhub, Postmates, Delivery Hero, anyone in the global food delivery space that's making acquisitions or is publicly traded or privately funded is seeing values per customer of a low of 130 to a high of, I believe, 330 or 350 per customer. Taking a low end value of that business alone of 120 per customer implies a value just on Atos Go of about 12 million. We just launched that in September, and we've committed about roughly 1.5 million in investment to it. We have an implied uplift in value of roughly 8x. Again, in a challenging environment because of COVID, but as things open up there, you're going to see both valuations return to normal as well as our business to continue to grow. So positioning that for a sale would absolutely drive interest, and it has. And by selling a stake in that and applying that to either a special dividend to investors and continuing to fund other projects within Weyland is what you'll see.
Okay, we get a question from Kay. This is a big picture question here. Kay is asking, what is the ETA for widespread adoption of AR, AI, and IoT?
Wow, that's a big question. On a bigger picture, you can segment them out. I mean, AI or artificial intelligence, it's also categorized as machine learning. That actually fits into the bucket of big data, because if you look at the landscape of big data companies, you will see a key element underlying of AI and machine learning, which both enables data analytics and underlying that the ability to provide their customers with insights and knowledge into how they can better promote and market their services to drive a sale. Okay, so underlying big data is AI and machine learning. That I think is evident in the big valuations that you see of the 12 to 15 or so publicly traded companies on senior exchanges. As it relates to AR, some of Jack and Wall Street Reporter's other featured companies that are in AR, I think the interest in their businesses is indicative on one hand to investor enthusiasm. I think in terms of a bigger picture, augmented reality and virtual reality, although somewhat leading edge, you could go back to several years ago and you look at the very widely popular game of Pokemon Go and the adoption that's seen, and that was what 4 or 5 years ago. So the markets overall have increased significantly for acceptance of AR. How does it fit into e-commerce, which is very real and very relevant, and how does it fit into m-commerce? Okay, so if you take a smartphone device and you look at what the big handset makers such as Samsung and Apple are doing in terms of enabling the camera to project either yourself or your apartment or your home to see what it would look like with additional furnishings, what you would look like with a different outfit, what art would look like in your home, AR in terms of events or conferences. I think that the overall environment is significant and certainly here to stay. And so any way that you choose to try to identify acceptance of that, I think you'll certainly find it. So I hope that answered the question. Did I leave anything out on that?
No, I covered it. Brent, one thing, well, I got a question for you or a comment maybe, but one thing about the big data valuations, what's interesting is that the valuations of these companies increase just automatically, like every second, because as they get more data, with machine learning, every second it just automatically becomes more valuable. Like Amazon, Netflix, as they get all this, it's like the valuations may not, they may not mean anything because these companies essentially are like perpetual motion or flywheel machines. So you have that here.
That's a great analogy, Jack. And if you look at the IPO environment right now, Zoom Info, they went public 2 weeks ago, or maybe 3 weeks ago. Their investment bankers priced them. I think they came out at 20 times trailing 12-month revenues. And I haven't looked, but I believe that the day they opened up for trading and closed it at closed that day, I believe they were up 100 and some odd %. So that implied a valuation metric of 40x revenues. We didn't even see that back during .com 1. Lemonade, an IPO last week, which is InsurTech, insurance technology, which is driven by AI underlying, priced at I think 30x revenues, and ended the day I believe at 70x revenues. So, and then Palantir, we've seen price talk increase sequentially, and so my point is that you're right. These valuations. I mean, how do you apply that towards a business? You can look at the stock charts of the publicly traded companies in data analytics in AI, and they've gone like this. So yeah, it's hard.
It's as I think as more investors discover, Weyland, I think there's going to be some of that effect. One thing I wanted to actually comment, you have a business in Indonesia. Brent, I don't know if you know, but a lot of Americans, they're geographically challenged. They don't really know where Indonesia is, how many people live there. So what is it? It's like 300 million population?
Sure. Okay. If you don't mind, I'm going to provide some context on the whole why we're there initially. So I was in Asia from 2003 until 2017. So I worked in North Asia and then Southeast Asia as well. And opportunistically, if you look at Southeast Asia, it's referred to as ASEAN. So it's almost like a trading bloc, if you will, kind of like the EU. So it encompasses a number of countries, with Indonesia being the largest, with 280 million people at last count, just slightly below the US in terms of population, 90% smartphone penetration. ASEAN on whole, I think, is 600 million people in the region. So it's extremely attractive. And again, the region is the #1 emerging market theme for institutional investors. That is why we originally went in. And by way of background, Create App, our core product, which originally launched in 2013, the whole goal with Create App was to go into neighboring countries from Singapore, of which Indonesia was the largest. When we originally looked at going into Indonesia with the Create App platform in 2016, the market just wasn't ready. It still wasn't ready when we launched in 2018, but the underlying element of having an e-wallet was. And so we took the view, okay, let's have an agnostic e-wallet that every other company, all these unicorn value companies, their e-wallets are there to enable their own ecosystem. So you use an e-wallet that they have to pay for their ecosystems, products and services. So those are what are called closed loop. Ours is open loop. So you can use our e-wallet to pay for anyone's goods and services. You can use it to pay for utilities, electric and gas, water. You can buy things from merchants. And you can pay for food through our food delivery app. So that's why we went into Indonesia. And again, if you do a little bit of cursory research online, and again, open source information is prevalent. I mean, Indonesia is just by and large extremely attractive to investors. And just one more thing I'll point out, you'll see on several of our slides the company SEA. Their ticker symbol is Sierra Echo, SE. Again, IPO in 2018, led by bulge bracket investment banks, $55 billion market cap. Why? Institutional investor interest. Goldman Sachs put it on their best idea list when it was at 42, and that was in January of this year. So it's up 300%. And again, why? Why is it trading at a huge multiple of revenues? Because it is the only publicly traded company that has a specific focus on fintech and e-commerce in Indonesia. And will we see other IPOs this year of some of those unicorn valued companies here in the US? I believe so. And should it help us, because we have a regional focus there, we have a business there, we have some unnamed partnerships with a very large NYSE listed fintech company. Sure, I think it'll absolutely help us, and in turn, our shareholders.
Okay, excellent. Any more questions? Let's see if we have any. Okay, I guess that's it for the live questions. So Brent, I want to thank you, and I want to thank everybody in our audience today. And we look forward to having you back, Brent, in a couple of weeks with some more good news. And we'll see everybody soon.
Terrific. Jack, thanks so much. And thank you to everyone watching, and all the best in the markets.
Thank you again, Brent.